Picture a quiet Tuesday morning. You're sitting at the kitchen table, both hands wrapped around a warm cup of tea, and an envelope lands in the post from Services Australia. You open it slowly. It's a debt notice. And the reason printed on that notice, the reason they want their money back, is your car. Not a fraud. Not a mistake you made on purpose. Just a number on a government screen that nobody told you to update. Right now, thousands of Australian pensioners are quietly paying a hidden tax on their own vehicle because Centrelink is still counting a car value from 3 years ago. And that one forgotten update could be costing you as much as $54 every single fortnight. That's over $1,400 a year. Gone. But there's more than one trap here. There's also the 14-day reporting rule that can trigger a formal debt notice if you miss it. And there's the gifting danger. A rule that catches some of the most generous people I've ever spoken with completely off guard. Stay with me to the end of this video. I'm going to walk you through all three, with real numbers, real examples, and a 5-step checklist you can act on this week. G'day Australia, I'm James Walker, and welcome back to Aussie Pension Guide, Australia's independent guide to the age pension, Centrelink, Services Australia, and everything that sits in between. Today we're talking about something most pension channels completely skip over, and that is how your car affects your pension. Not just when you buy one, but when you sell one, when you give one away, and every single year it sits in the driveway losing value, while Centrelink holds on to an old figure. I want you walking away from this video knowing exactly how vehicles are assessed under the assets test, what the rules are on gifting a car to family, and how reporting a car purchase at the right time can actually increase your pension. Let me walk you through this properly. Before we get into it, if this channel has helped you or helped someone in your family understand their pension better, do me a small favor and hit that subscribe button, then tap the bell. Every week I put out a new update, completely free, covering changes to Centrelink, rates, and entitlements. It takes 2 seconds and means you'll never miss something that could affect your income. Let's put some perspective around why this matters right now. In 2026, roughly 2.5 million Australians are on the age pension. According to Services Australia, more than 60% of those recipients are asset tested, meaning the value of what they own directly determines how much pension they receive. Most people think about the house, the superannuation, the term deposits. The car doesn't get the same attention, and that's exactly where the problem begins. From March 20th, 2026, the maximum single-age pension sits at $1,200.90 per fortnight. That includes the pension supplement and energy supplement, as confirmed on servicesaustralia.gov.au. For couples, it's $905.20 each per fortnight. Those are significant figures. They're worth protecting. Here's what the asset test actually does. For every $1,000, your assessed assets go over the threshold, which sits at $321,500 for a single homeowner from March 20th, 2026. Your pension drops by $3 per fortnight. So if Centrelink has your car listed at $60,000 when the current market value is $42,000, that $18,000 gap is reducing your pension by $54 every fortnight. That's $1,404 over the course of a year, quietly, invisibly, from a number on a screen that you never went back to update. Now, let me take you through the 3 traps and then give you the checklist to fix them. Now, here's the first thing I want you to understand, and honestly, this might be the most useful 60 seconds you spend this week. Centrelink does not automatically update the value of your car. Say that slowly. They do not automatically update it. When you first reported your vehicle to Services Australia, they recorded the market value at that moment. Unless you go back in and change that figure, it stays on the system, unchanged, year after year, as the car quietly depreciates on your driveway. A vehicle is what Services Australia classifies as a non-financial asset. Unlike your superannuation balance or your term deposit at Commonwealth Bank, a car is not subject to deeming under the income test, but it absolutely is counted under the assets test. So an outdated value costs you real money every fortnight. The fix is straightforward. Head to redbook.com.au. This is the same vehicle valuation guide recommended by the Department of Social Services. Look up your make, model, year, and approximate kilometers. Choose the private sale market value, not trade-in, not insured replacement value. Private sale. That is the figure Centrelink should be holding. Then log into my.gov.au, link to Centrelink, go to Income and Assets, find your vehicle, and update the number. 5 minutes. That's all it takes. Take Barry, 71, from Bendigo. He bought a Toyota LandCruiser in 2023 for $65,000. He did the right thing and reported it straight away. Good on him. But 3 years on, that same vehicle was worth $46,000 at private sale. Barry had no idea Centrelink was still counting $65,000. His daughter helped him sit down one afternoon with a cup of tea and update the figure through MyGov. His pension went up by $57 per fortnight. That's over $1,400 a year for a 5-minute update he'd been putting off for 3 years. Here's what most people get wrong on this one. They assume that because they already told Centrelink, the job is done. It's not done. Depreciation is continuous, and so is your obligation to keep that number accurate. Now pay attention to this part, because this one doesn't just cost you money. Get it wrong, and you can end up with a formal debt notice, and in serious cases, an investigation under the Social Security Act, 1991. When you buy a car, sell a car, trade one in, or receive one, you have exactly 14 days to notify Centrelink of that change. 14 days, not a month. Not when you get around to it. 14 calendar days from the date the change occurred. I've spoken with people who waited 3 months because they were flat out settling into a new vehicle, or they assumed the car dealer would handle it, or they simply didn't know the deadline existed. Services Australia doesn't ask about your reason. If you were overpaid during that gap, even accidentally, they will issue a debt for the difference. See, here's the thing though. There's a genuinely positive side to this rule when you use it correctly. If you spend $50,000 from a savings account at NAB on a car, that $50,000 is no longer a deemed financial asset. From March 20th, 2026, balances above $64,200 for singles are deemed at 3.25% under the upper deeming rate, as confirmed by dss.gov.au. The moment that money becomes a car, a non-deemed physical asset, it leaves the income test calculation entirely, but that benefit only flows through if you report the change promptly. Take Margaret, 68, from Newcastle. She had $110,000 in a savings account, being assessed under the income test. She bought a reliable Subaru Outback for $50,000, reported the change to Centrelink within the fortnight, and her assessed financial assets dropped from $110,000 to $60,000. Her deemed income fell. Her pension went up. She did it right, and she reaped the reward. The rule is simple. Log into MyGov on the day you take ownership, or the very next morning. Don't leave it. But here's where it gets interesting, and this is the one I genuinely want you to stop and think about. You've got an older car. It's been solid, but you've just upgraded, and your granddaughter needs something to get to work. You say, "Love, just give me $500. It's yours." You're being generous. You're being family. But according to Services Australia, there's a name for what you just did. It's called gifting, and gifting has strict legal limits. According to servicesaustralia.gov.au, the annual gifting limit is $10,000 per financial year. The rolling limit across 5 consecutive years is $30,000 total. If you sell or give an asset for below its market value, the difference is counted as a gift. Full stop. So if that car has a Redbook private sale value of $16,000 and you hand it to your granddaughter for $500, you've just made a $15,500 gift, $5,500 over the annual limit. And Services Australia will treat that excess as a deprived asset, meaning they count it as though you still own it for 5 full years. I know the paperwork on this can feel overwhelming, and you're not alone in that. But the 5-year deprivation rule is real. It applies to vehicles, and it can genuinely reduce your pension for a very long time based on a moment of generosity that you never thought twice about. The right approach is straightforward. Either sell the car at its genuine market value, get a written Redbook estimate, keep a record, or work through the gifting limits thoughtfully across the financial year. And speaking of which, the current financial year closes on June 30th, 2026. That is very close. If you've already gifted something this year and you're thinking about transferring a vehicle as well, check where you sit against that $10,000 cap first. Now here's something most channels don't talk about. For pensioners sitting just above the income test threshold, buying a car with cash can be a genuinely sensible move. Here's the reasoning. Cash in a bank account, whether it's a savings account at Westpac, a term deposit at ANZ, or a managed fund, is a deemed financial asset under the income test. As confirmed by dss.gov.au from March 20th, 2026, balances above $64,200 for singles are deemed at 3.25% annually, regardless of what you actually earn. A car sits outside that calculation entirely. It counts under the assets test, but not the income test. So a single pensioner with $100,000 in the bank who spends $50,000 on a vehicle sees their deemed income drop immediately. If that moves them below the income test threshold, their pension increases. This isn't a loophole. It isn't clever accounting. It's the system working exactly as it was designed. And the important thing, I want to be clear, is that you genuinely want and need the car. Independence, getting to medical appointments in Toowoomba or Geelong, visiting family. The strategy makes sense when the car decision was already yours to make. One final thing, and this one is practical in a different way. If you hold a pensioner concession card, you may be entitled to free or significantly discounted vehicle registration. In New South Wales and Queensland, for instance, PCC holders access real, meaningful concessions on annual Rego costs. But when you change vehicles, you need to reapply for that concession with your new registration. It does not transfer automatically. I've spoken with people who bought a new car, re-registered it, and quietly lost $300 or more a year in concession savings because nobody mentioned the reapplication step. Don't let that be you. When you change vehicles, contact your state or territory roads authority and confirm your concession is in place on the new registration. If you're finding this helpful today, can I ask one small thing? Drop a quick comment below, even just "Thanks, James," or your first name and where you're watching from. Something like "Thanks, Cheryl," from Hobart. When real Australians engage with a video like this, YouTube shows it to more people who need it. There are seniors all around this country who don't know these traps exist. Your comment can genuinely help them find this. Here's exactly what I want you to do this week. 5 steps. Write them down if you can. Step 1. Check your car's current market value. Go to redbook.com.au and search your vehicle's make, model, year, and approximate kilometers. Select the private sale value, not trade-in. Write that number down. Step 2. Log into MyGov at my.gov.au, link to your Centrelink record, and open the Income and Assets section. Find your vehicle listing. Compare the figure on file with your current Redbook number. If they differ, update it. This single step could increase your pension within your next payment cycle. Step 3. Review your gifting history before June 30th, 2026. Add up any money or assets transferred to family members below market value since July 1st, 2025. Confirm the total is under $10,000. If you're approaching that limit, hold off on further transfers until the new financial year opens on July 1st, 2026. Step 4. Call Centrelink on 132300. This is the older Australians line, open Monday to Friday, 8 in the morning until 5 in the afternoon. If you're unsure how a planned car purchase, sale, or transfer will affect your specific pension payments, ask to speak with a financial information service officer. Just say, "Financial Information Service," when the line answers. It's a free service. It's completely impartial. These officers can give you a personalized projection of how any change will affect your entitlements, before you make a decision, not after. Step 5. Update your registration concession. If you hold a pensioner concession card and you've recently changed vehicles, contact your state or territory roads authority, Vic Roads, Transport for NSW, TMR in Queensland, depending on where you live, and reapply for your pensioner registration concession. Do not assume it carried across automatically. 5 steps, all of them free, all of them doable from your kitchen table or from your local Australia post, or with a quick phone call to Centrelink. Before I finish, I want to say something to you directly. Something I mean. You worked your whole life for this country. You paid taxes decade after decade. You raised your families. You turned up to jobs and communities and responsibilities that kept this country going. In cities like Brisbane and Perth and Darwin and in small towns all the way across regional Australia. This pension is not charity. It is not a favor the government is doing you. It is what you earned. It was promised to you, and you have every right to claim every single dollar of it. Don't let confusing paperwork or an outdated number on a screen cost you what belongs to you. Now, of course, every situation is different, and what I share here is general information, not personal financial advice. For your specific circumstances, always speak with a financial information service officer at Centrelink. It's a free service most people don't even know exists. If this video helped you today, please give it a like. It tells YouTube this content is worth sharing. Subscribe if you haven't already, and please pass this on to someone who might need it. A parent, a neighbor, someone from your RSL club or your local bowls group who might be sitting on an outdated car value right now. And leave me a comment. Tell me what topic you'd like covered next. Because in the next video, we're going to look at how a caravan or motorhome is assessed under the Centrelink Assets Test. And fair dinkum. It's another one that surprises a lot of people. This is James Walker from Aussie Pension Guide. You've earned this, Australia. Take good care of yourselves, and I'll see you in the next one.